I'm going to hit the go live button, and you're now live.
Excellent. Thanks very much. And good morning, everyone. Welcome to today's pension panel meeting. Claire, apologies for absence.
We haven't received any, Chair.
Thank you. Urgent business, I have none. Declarations of interest, I'm sure they're all listed, but just in case, I hear no one. Thank you. Minutes of the last meeting that was held the 7th of December last year. Is that agreed?
Agreed.
Thank you. Right, okay, let's move on to item 5, yeah? Julian?
Yeah, thank you, Chair. Members are asked to know the draft business plan for 2021-22. This report is in its usual format and sets out the agenda for the panel for the next financial year. Members should know this plan excludes any new manager selection meeting, which will be done outside of these dates. If members would like to add any items to the agenda, please let me know. Other than that, Chair, I'm happy to take any questions.
Okay, thanks, Julian. Any questions? Sid?
No.
Looks good to me, Chair.
Yeah.
Okay, thank you. So I
Yeah.
thought you was going to ask the question. Okay, that's agreed then. Thanks very much. Move on to item 6, page 25. Julian?
Yeah, thank you, Chair. Members are asked to note the annual report for the pension board for 1920 as per Appendix A. This report lays out the activity of the board during the last financial year and their business plan going forward. Full details of the activity of the board is in Appendix A. It should be noted that the board were only able to meet twice last year, partly due to the COVID-19 pandemic. Happy to take any questions in this report, Chair.
Okay, thank you. Any questions to officers? No? Everyone happy to agree that?
Agreed.
Okay. Noted. Thank you very much. Alison, item 7.
Hello there. I do need to point out, so this is a report in respect of the restriction of the public exit cap, 95k cap. It's a further update from the last meeting. I do need to point out that in para 1.1 of the report, I said that the regs had been revoked on the 12th of February. They've actually been disapplied there. The regulations were actually laid on the 25th of February and are coming into force from the 19th of March. So that's the slight amendment to the report. So this report is asking panel to note that the regs have now been revoked, to note that the previous decisions we made at panel, the policy decisions we made at panel no longer apply, and to agree that we get the fund actuary to carry out a further review of the factors, because the factors now no longer apply and our previous factors were not gender neutral and were very old. So basically everything you agreed at last meeting no longer applies. What it means is, rather than me going through the report, if I can just summarise, is that okay with everybody? Yeah.
Yeah.
What it means is that any redundancies between the 4th of November and the 11th of February, we would need to put those, if we'd paid out a reduced pension, we would need to put those people back into a position where we paid an unreduced pension. I've been informed by the team we didn't have any, but I will naturally go back and get that checked as well. Where we were going to use the GAD factors to calculate any costs, we won't do that. We will wait and get the new costs, if that new factors, if you agree, and apply those without bringing them back to panel, if you agree, that based on what the actuaries recommend. And basically it's as if it never happened. What I would like to say is it won't go away. We are being told they are looking. We believe it was probably a U-turn due to the various different judicial reviews that were going on in the courts. But that is it really. I mean, I'm happy to go through the report as it's written, but it seems a bit time consuming when basically it's just to say to you, everything you agreed at last panel doesn't apply. We will now pay fully unreduced pensions to anybody who is made redundant or retired on grounds of efficiency. Employers will be required to pay the full strain cost. And as I say, because I don't think we've got any cases, to go back and revisit and speak to employers about, did you pay an additional top up? Any questions?
No, it's
Okay,
straightforward.
I don't have any. I don't think anyone's got any questions. But perhaps if when you do double check on this, Alison, if there are any members that are involved, perhaps you could just let us know.
Yes,
not
we'll
that
do.
we can do anything, just so we have that information at hand.
Yeah, will do.
Yeah. Thank you very much. Okay, is that noted?
Noted, yes, Chair.
Thank you very much. Item 8, Julian.
Yeah, thank you, Chair. Members are asked to agree the governance compliance statement in Appendix A. Regulation 55 requires all administrating authority to prepare, review, and publish a governance compliance statement. The governance compliance statement have not changed much from last year, with the only slight change in that meetings are held virtually during the COVID-19 pandemic in line with guidelines. As previously discussed here, we don't know when those guidelines will expire in terms of held a meeting virtually, but we'll revert back to the panel if we have any update from committee service.
Okay, just so you know, during our pre-meet, Paul was saying that he was in a meeting and there was talks about maybe has to change by May. Paul, did you want to make a comment on that?
Well, it was kind of hearsay actually, but I was at a meeting recently where somebody claimed that the permission to hold meetings remotely had an expiry date, and that expiry date was in May, and if that wasn't extended, then the ability to hold virtual meetings didn't exist beyond that point. But I can't say that as gospel, but it just came up as an issue at a meeting recently, and we mentioned in the pre-meet whether that was the case or not. I can't confirm or deny necessarily.
Well, clearly we'll have to wait and see, and Claire, I'm sure you'll advise us when we all have to stand outside the town hall if we're not allowed in. Okie doke.
Sorry, Chair, just to confirm, it is the case that the remote meeting regs do expire in May.
Oh, that is good. Okay.
Yeah. So currently there's some lobbying taking place to have that extended.
Is that a government decision that they would have to carry
I
on?
believe so.
Well, we other than that, we can't hold a meeting till after the 21st of June.
I'm not sure of the date.
We'll be in Purda anyway, so don't matter.
Yeah, but I can update you all as soon as I hear confirmation.
Thank you.
Whether that's been extended.
Thanks very much, Claire. Okay, happy to agree the governance?
Yes.
Yeah.
Yes.
Thank you very much. Item 9, Julian.
Yeah, thank you, Chair. Members are asked to note the updated pension fund risk register as per Appendix A. The risk register is a tool for managing risk within the pension fund. Members should note that sections of the risk register are taken to panel board quarterly for review and comments. As noted in section 3.6 of the report, there are 2 areas that require senior management attention. These areas are the financial market volatility risk, which could cause a sharp reduction in assets, and cybersecurity risks, which could have a large organizational impact now that we all work remotely. The impact of both of these risks are explained in the risk register in more detail, but happy to take any questions, Chair.
Thank you very much.
Chair, I was going to say, can we have a little bit, some more information, please? Because it's quite worrying about I know you're saying it's all in the report, but can you explain sort of in layman's terms that there's cyber security risk? That's quite worrying.
Yep.
Yeah, thanks.
Yeah.
No, thank you. I'm just going to go down to the actual part of that risk. Bear with me 1 second. So it's on page 86.
Mm.
So just to give you some kind of overview. So in terms of the pension fund, we're governed by the council itself. So the council facilities, the pension fund will access those IT facilities. So this risk has been the council risk as such in terms of their IT infrastructure. What's been noted in this specific risk is around the cybersecurity incidents. So around, I think previously in other council, the found vulnerabilities in where hacks or other outside persons been gaining access to systems. So they flagged up as a vulnerability just in general, they found in other local councils. As they start to roll out more and more IT equipment, I think they're starting to look at how those systems, if any vulnerabilities in those systems. What can't, with my own knowledge, I can't go into specific details, unfortunately, with this specific, but I can always come back into an email from the IT, from the head of IT,
Yeah.
give you a bit more insight into why they've rated this as a high impact risk.
Yes, please.
I do know that
Thank you.
all mobile, we've been sent, and council has been sent an email that we've got to change all our mobile ways of working, where everything, I don't know, they're bolting something else on, I guess, but I'm not sure what it is, but we've all got to do that. So that may be to do with this, it may not be. It just seems that it probably is, but I don't know.
And
Yeah.
what I can also do, Chair, I can find out where specifically in which council panel this item is looked at in terms of IT security, so where it's also been reviewed, because we're only looking at part of the pension fund, but I'm sure that this has been reviewed somewhere in the council at another committee.
Who does IT, Sis? Do you know?
Linda Perks.
So Linda will be looking at this, I guess. Okay.
Thank you, Chair.
Thank you. Right. So that's I think we've already agreed that. So if we move on to item 10, Julian again.
Yeah, thank you, Chair. Members are asked to note the draft pension fund for the period ending the 31st of December 2020, as per Appendix A. This report provided a draft position of the fund after the first 9 months of the financial year 2021. As noted in section 3.1 of the report, the value of the fund was 1.49 billion. That's an increase around 21% from the 31st of March 2020 position. The majority of the fund recovered well from the drop in value as we saw at the 31st of March due to the COVID-19 pandemic, with the exception of the multi-asset fund and the property fund, which saw a reduction in value. The next report will look at the manager performance in more detail. So we can talk about a bit more on those two managers and why the performance was below. Had to take any questions, Chair.
Any questions to officers? I'm not seeing any. So we're happy to note.
Yes, agreed.
Thank you. Which takes us on to item 11, which is Kenny's doing. We're in closed session now, so can we stop recording?
Let me just do that, Chair. I'll confirm anything.
So we're waiting to be trained by the London Civ. Thank you very much.
Great, no problem. Do you have the slides in front of you, or do you want me to?
If you could share it, that'll be great.
Okay, let me just make sure I've got the latest version, which was signed off.
Oh,
So I'm just going to share my screen now. Can you see the main slides? Or are you seeing the presenter view?
Yeah, it's the presenter view at the moment.
Is that better?
That's better now. Yeah, that's good.
Okay, great. Perfect. So, welcome. Sorry about that. I was just getting my screen ready. So I will just move on to the next slide. Our computer's being a little bit odd. Right, I've got it on the right view now. Great, okay. So sorry about that. My name's Jacqueline Jackson. I'm the Head of Responsible Investment at London CIV. Obviously, London CIV are very committed to responsible investment, and we recognise that this is part of our fiduciary duty to recognise where environmental, social and governance issues may positively or negatively impact on fund solutions, which we understand when we consider our investment strategies and decision-making processes. But obviously what we think might have been helpful is to set a bit of context in terms of what responsible investment is, why it's important, and I thought I could potentially add a bit of colour to all of the acronyms by providing a bit of an overview of what sustainability means, why it's important and how that can have an impact on investment decisions. So a slightly nostalgic slide to begin with is sort of what I remember sustainability to be like in the 70s and 80s, when much of what we learned about was WWF pencil cases and saving the rainforests. But I suppose what despite sort of talking about sustainability using plastic pencil cases and merchandise, this was sort of the beginning of what became a very important movement. That picture you can see on in the middle is also from the 70s. So that was actually the founding of Earth Day on the 22nd of April. And yet obviously, despite that being over 50 years ago now, where this was in Manhattan, where their Fifth Avenue was closed to all motor vehicle traffic for the first time ever to celebrate Earth Day, obviously things haven't necessarily gone according to plan in terms of action. So if we look at how things have changed from 1970 to 2020, we're obviously still living in a planet that's in danger. We still have strikes for climate action, which are only increasing. And obviously the recent pandemic is a direct result of biodiversity loss, natural resource constraints and other environmental factors. So just to put it into a bit of context, I always like to refer to what's called Country Overshoot Day. So if you've not heard about Country Overshoot Day, it's quite interesting. It's essentially the day in the year when Earth Overshoot Day would happen if everybody lived like those in a certain country. So Earth Overshoot Day, imagine, is the day every year when the Earth has run out of its natural resources for the year. So you shouldn't really be using more than one Earth's resources per year. But what happens is, if everybody sort of, if we look at what the planet's currently using and what the planet's currently polluting, we're actually using more like 2.5 Earths every year. And what's worrying is this date by which we've used up the world's natural resources gets earlier every year. So you might not be able to see the specific countries on your chart, but you may if you look closer at the presentation later. You'll see that if everybody lived like Qatar, the Earth would have completely run out of its natural resources by February the 11th. Whereas if everybody lived like those in Indonesia, for example, on average, the world would outlast all of its natural resources until December the 18th. So I did a little calculation to find out what my personal overshoot day is. And I'm pleased to say that I'm beating the average in Britain, which is over in May each year, but mine's actually still the 29th of July. So if everybody obviously lived in the lifestyle that I lived, then the Earth would be running out of resources incredibly quickly. And if everybody lived like me, we'd obviously need 1.5 Earths. So not particularly impressive stats from myself. but just helps to give it a bit of context as to what's going on. And so what is kind of interesting and maybe helps put it into a bit of perspective is that the average sort of cost or the environmental footprint of everyday items is quite significant and something that we don't normally think about on a day-to-day basis. So just a couple of stats that might be interesting, for example, is that it takes over 15,000 litres to produce a kilogram of beef. It takes nearly 4,000 litres to produce a pair of Levi's 501s, if anyone remembers those jeans. And it takes, in fact, 132 litres just to produce a very small cup of coffee. And so thinking about something like fashion, for example, the average UK household, for example, owns about £4,000 worth of clothes, but around 30% of clothing in wardrobes hasn't been worn for at least a year. And the cost of this unused clothing in the wardrobe is estimated to be around 30 billion. And that cost is not just the financial cost associated with clothes, but it's actually the environmental negative impact cost. And I think it's quite interesting to sort of use fashion to set the context, because if we think about the total supply chain of fashion and what it looks like from start to finish, you know, on the right, what you can actually see there is a little girl who's got a deformity which is caused by cotton pesticides. In between about 1976 and 2000, when it was banned, although there's still cases of this happening today, more than 50,000 villagers in a district in Kerala were exposed to a pesticide called endosulfan, which is a persistent organic pesticide, and that caused significant deformities. Whilst it's still banned, that still exists in parts of China and India. But if we move down the supply chain, of course, we've got major issues when it comes to even the stitching of fabric. You can see the Rana Plaza collapse to the left of the little girl, which killed over 1,000 people and injured a further 2,500. And of course, before clothes even get to that stage, which is the sweatshop stage, they obviously need dyeing, which means that many toxic chemicals feed into groundwater, therefore affecting various parts of the ecosystem. And even if we go beyond that and we think about where it goes next, when we think about the catwalk or Instagram or Amazon, we've now got clothes competing for prices, pushing additional seasons worth on customers in terms of clothing ranges, many of whom in Western societies can't even afford them and may get into significant amounts of debt. And of course, that can have other societal implications, adding pressure to teenagers, not just in terms of debt, but in terms of body image, for example. So this might sound a little bit random because we're supposed to be talking about responsible investment, but in fact, it's incredibly directly related. The chart that you'll see on the bottom right are anonymized regions from a study that I did in a previous role on the cotton supply chain for a client. So this is a corporate company that London CIV would most likely be invested in. And what we're seeing here is the average cotton price, the red line at the bottom, and the risk-adjusted cotton price, which are the grey bars. Essentially, any region where the grey bar is taller than what we're currently paying for cotton is a huge financial risk to the business or to the investor. Because, of course, if we suddenly have a drought or a water shortage, or some of these environmental risks get externalized, in a number of different ways. Maybe a factory's closed because it's collapsed. Maybe there's been stakeholder pressure or protests. Maybe there has been a drought and the cotton price has been pushed up. Then, of course, we would suddenly have to pay the risk-adjusted price or something closer to the risk-adjusted price than the average cotton price. And that is a direct risk, obviously, for the companies that we may invest in, but it's a risk as well for those investors invested into them. There's a good example of H&M, which is a massive cotton buyer. And I think in 2011, after the droughts in China, they lost, I think, a quarter of their operating margin in just 1 quarter, just due to the drought. And that was simply because they couldn't push the increased cost onto customers because they already have such low margins to start with. And the problem is that these issues are not really getting better, but they're actually getting worse. As you know, obviously the global middle class is increasing from 1.8 billion in 2009. It got to 3.5 billion in 2017. And I wrote these slides, this stat last year, but we're expected that we're still going to have growth to 4 billion by 2021, by the end of this year, and reach 5.3 billion by 2030. So unless consumer behaviour and consumption patterns change, by 2030, the demand for food, water and energy will increase by approximately 35%, 40% and 50% respectively. Of course, many of these issues include things like plastic, which has only got worse because of the pandemic, and that is obviously entering our oceans each year. We estimate that if the current trends continue, there are likely to be more plastics by weight than fish in the ocean by 2050, which is quite a miserable statistic. Essentially, when we think about natural capital, plastics, pollution, the environment that we live in, we can think of it of something called natural capital. Natural capital is obviously just thinking about ecosystem services that we take to produce items such as from land or from water. And it could also refer to pollutants like greenhouse gases, air pollution, waste, land and water pollutants. But what's interesting for investors and business is understanding that interplay between impacts and dependencies. So we talk a lot as investors about what is our impact, what's our carbon footprint, but actually what we depend upon, what businesses depend upon to make these items, so the water they need to make the cotton, to sell the t-shirts, is actually where we're even more at risk from financial impacts to balance sheets, for example. And that's quite important because this is an area that's not often talked about. We talk about impact, but we maybe don't understand what we depend upon. So if obviously a corporate company's strategy is to grow by 25% over the course of the next year or two, and that's part of the reason that we're looking to invest into them, obviously we need to be aware that if there simply aren't 25% more natural resources where they're sourcing from, then obviously they can't really meet that strategy successfully. And as you know, governments will always prioritise communities as opposed to foreign corporate supply chains if there are, for example, droughts or other natural resource constraints. And I've just sort of simply put a quick example here of where this risk can be translated into financial risk, is that cattle ranching in South America uses 16 times the natural capital value than it generates in terms of operating revenue. And again, what that means is if any of these risks get internalized, so taxes are put into place by local governments in order to make sure that the community are protected, or if costs get internalized due to reputational risk, or due to any other environmental factors or physical risks, natural disasters, then they could be potentially costing 16 times more to create what they're creating than they are making from revenue. And this is one way that some investors analyze the ways in which some companies may be more sustainable than others. You know, if the operating margin more than enough makes up for the potential natural capital risk or dependency, then obviously it's a much more secure business, and there's much less risk that could be internalized. And so just simply explaining kind of how this works is that often we think about cost to society when we talk about natural capital. So it's quite a neat way of translating traditional impacts like tons of greenhouse gases or NOx, SOx and various other types of particulate matter into an actual monetary value that reflects the cost to society. And this is the kind of cost that we can start to use in order to understand a bit better what that could mean from a business perspective or from an investment perspective in terms of lost returns. But of course, this is very much related to investment. The climate crisis alone was calculated to blame for about $67 billion worth of Hurricane Harvey's damage. The UK economy obviously was hit by COVID, and the floods in England had a significant financial impact for locals, for companies, for governments, and for investors as well. And so we're very much in a world in which the impact on the environment and the dependencies that we have on the ecosystem services that we use are very much related to business success. And these aspects can't really be seen in silos anymore. There's plenty of opportunities and risks that we can look at, and examples of where these types of impacts or dependencies have had a direct financial relationship with business success or investment results. Some of these could be to do with opportunities, so where we see that there might be opportunity to invest in climate resilience or climate adaptation. The organic food market, for example, grew by 10%, reaching 72 billion in the earlier half of the decade. Whereas we've had plenty of examples where a multinational beverage manufacturer, this is actually Coca-Cola, had to abandon $105 million worth of bottling plants in India because the government had to prioritize local communities' water resources. And so obviously what we've got here is a bit of a perfect storm, where we've got an erosion of natural capital, where we've got increased climate change and physical risk. Yet on the other side, the demand side's increasing. So we've got dwindling resources, increased pollution, and yet more demand on those resources, which is putting a huge amount of pressure and strain, and essentially a bit of a race to the bottom in terms of resources. We've got at the moment over a fifth of the world's population living in water-stressed areas. Interestingly, that includes places like London, where the population is very high and water stress is also high. That's only set to increase. And what's interesting is if you look at the World Economic Forum's report on water scarcity, you'll see that most of the water-stressed regions specifically are places like London and New York, where they are major economic hubs. So again, more concerns to think about for the future. To try and sort of bring it back to the finance industry, so I can talk a bit more about what London CIV are doing for the second half, is obviously these shifts in our climate are bringing profound implications for not just insurers, but for general financial stability and our economy. And you may be familiar with Mark Carney's famous speech on the tragedy of the horizons when he was working at the Bank of England still, before he joined to be a special climate envoy for the UN, is that the past is not a prologue, and the catastrophic norms of the future can be seen in the tail risks of today. So essentially what he was concerned about is that continuing, with business as usual, even though it's worked for us in the past, simply will not work in the future. And a nice quote, which I always like to use from Peter Harrison at Schroders, is that he recently said that he thought ESG won't exist, and obviously won't even be sort of its own subcategory anymore, because it will be simply fully integrated into investment. So obviously the dream for many people like me working in responsible investment is that my job potentially won't exist in a few years, because it simply will be fully integrated into the investment process. And these risks from a financial perspective obviously extend across many different factors. So there's potentially liability risk, where increases in temperature could result in actual losses for various global assets, where physical risk could actually create damage and stop resource supply. So if we look at some stats on what physical risk really means, we think a lot about the number of weather-related losses. So since the 80s, that's tripled to $50 billion. In the US, for example, they estimate that over 200 to about $500 billion of coastal property could be below sea level by 2100, which is pretty much most of Miami. And what you can see on the right is S&P 500 utilities sector assets actually overlaid there with wildfire risk. And that's just literally one potential physical risk out of about 10 different risks which are on the top list in terms of asset liability. But we've not just got obviously physical risk to consider, we've got to think about transition risks. So as you can imagine, as transition risk increases, so kind of governments putting a price on carbon and trying to do something about it internally to reduce carbon consumption, that's called transition risk, and that would obviously increase, meaning that the cost of carbon taxes would be internalized by the business, and that we hope would make physical risk go down. But where transition risk might be low because governments aren't doing much about the cost of carbon or taxing these aspects, then the physical risk could increase, meaning that, of course, not much is being done about it, and therefore those physical liabilities become higher. It's significant. It's significant, the price of carbon. We've already had a significant increase in this. I think over 170 countries have actually committed to putting, or estimated to put, a price on carbon in the coming years. But then, of course, it's not all bad news. Of course, there's a huge opportunity associated with the green transition. So clean energy alone, or the climate transition, is forecast to be a $93 trillion opportunity through a number of different sectors, including clean energy, water efficiency, low carbon transport and infrastructure. And that is some of the opportunities that we obviously want to capitalise on at London CIV. So really, in terms of responsible investment strategy and how can that feed into products and the way in which we operate, for us, it's very much about understanding negative impact in order to mitigate that risk, engage with companies to check that they are aware of how these types of risks can be internalised, and then, of course, to capitalise on some of those opportunities. So just to give an overview of what we're doing before I stop for any questions, we obviously have a keen commitment to responsible investment and engagement. It's a huge priority for our clients, but primarily this for us is about supporting the company's investment objectives. Less so about trying to make the world a better place. We genuinely can see and understand the financial link that this has to our investment objectives, and it's a key part of our fiduciary duty. But obviously, we want to lead by example and raise the bar on responsible investment, because only by doing this together or collaboratively with other pools, other financial institutions and other asset owners can we actually move the dial on some of these issues, thus de-risking that investment landscape for everybody. And then, of course, we want to be able to provide value to clients by helping them with data and analysis that help them with increasing responsible investment needs. So obviously there's assets outside of the pool, and we hope that we can help provide some of these pieces of research and insights to help clients, not just with assets through London CIV, but externally as well. You'll probably be aware that ESG regulation is increasing. That chart on the left is something that keeps me awake at night, which is the number of policy interventions annually. And you can see that they're rising exponentially. So in the short time that I've joined, we've had about several different new rules come in on how we report on ESG. So it's incredibly important for us that we can help support clients with understanding this changing landscape. And just to kind of bring it back to London CIV, this is the way that we're trying to think about achieving our primary goal of prosperity, for our beneficiaries. We think of it as achieving exemplar people, planet, and principles of governance factors, understanding how companies are performing against these types of metrics in order to lead to the primary goal of prosperity and being able to pay pensions. I haven't made up these categories. They were actually defined by the World Economic Forum at the end of 2020. And what's interesting is that at the end of last year, probably as a direct result of COVID, although it was already sort of happening, is that there's been a lot of talk about stakeholder capitalism. So you might have seen some of that in the responsible investment news or in the Financial Times recently. But obviously, historically, we've always spoken about shareholder capitalism and how to increase value for our members or for the funds themselves. But what we're hearing more and more about is this concept of stakeholder capitalism, It's becoming increasingly hard, of course, for companies or for investors to simply talk about pure profits without understanding the direct link between ESG performance and financial risk or potential performance, and the fact that society is genuinely demanding that there is a better alignment of value creation with the protection of values to achieve sort of global prosperity. And I really think COVID has keenly highlighted many inequalities which have created a bit more of a demand for more, I suppose, I wouldn't say ethical, but more responsible business generally. And so just briefly, kind of the way that we're thinking about this is that obviously when we talk about risks, there's sort of the social materiality side, where there's lots of social issues on one hand, but then there's the financial materiality, which traditionally the investment world should be more focused on. But actually these two dual materialities cross over quite significantly. And we end up where many social risks translate into financial risks, and of course, vice versa. And the way in which we're defining our priorities is to think from a global driver's perspective. So what are the macro risks in the world, such as climate change, such as water scarcity? How is that impacting policy and regulation? And then from a London CIV perspective, where are our holdings and investments? What is our asset-specific risk? And where can we actually have influence in order to define which priorities we want to focus on? And this essentially is just a bit of an overview of what we're currently doing at the moment. So at the top, you'll see that 5 of our new investment beliefs are focused specifically on responsible investment. They will be released this month or the beginning of next month. So I hope that will be something that you can take a look at when you've got a bit more time. And it's something that we're, of course, integrating, not just in our own operations, but in our product development, in the investment decisions that we're making, our stewardship practices and the way that we engage and vote, the way that we collaborate with the industry, and the way in which we will be disclosing on some of these risks and opportunities. I haven't touched on this yet, but obviously in terms of products, we're not just looking at the products that we currently have to think about what the impact is, although that's an important part of our strategy, understanding what the climate footprint is and what the ESG impact of our existing products are, but also being able to capitalize on some of these opportunities, such as through our low carbon passive fund that we're exploring, through the Paris aligned equity fund, and through things like the renewables mandate as well, where we can actually not just talk about impact reduction, but how can we have a more positive impact and capitalize on the low carbon opportunity as well. And just in a more summarized version, this is sort of how we're thinking about responsible investment and engagement. It is a constant cycle, so this isn't a linear process. We will be, on an annual basis, always researching and reviewing client policy, undertaking peer review, considering new regulation and our investment beliefs to feed that into our responsible investment engagement policy, which will be updated annually. And they will be designed into our voting principles, stewardship code and climate policy. It will be implemented throughout everything that we do and disclosed on an annual basis, and obviously in the interest of transparency. So I don't want to maybe talk too much because I know that we're very much close to the end of time and I want to save space for questions. So just very briefly to let you know that this is something that we're working on. We have already completed the first climate risk analysis in line with the best practice guidelines on climate risk. And I'm very pleased to say that the consolidated London CIV pool at the moment has a lower carbon footprint than the MSCI world across every single carbon intensity metric. And it has a lower exposure to fossil fuels than the MSCI world. We're at an exposure of 3.5% versus 6.8% for the benchmark. And on coal, we're only at 1.9% versus 3.8% for the benchmark. But of course, we have ambitions to go further. And the consolidated London CIV pool isn't yet Paris aligned. We are above 3 degrees. But this is a great opportunity, of course, because we are ambitious to set targets towards net zero. And when we have looked into the feasibility of that and consulted with all of our clients, then of course we will be wanting to publish a shorter term target as to when we think we will be Paris aligned by as well. So I don't want to kind of talk any longer. Let me just pause for any questions.
Thanks very much, Jacqueline. Any questions?
Could I just raise one? Could I just raise one point?
Oh, yes.
Yeah, so about reporting. I mean, obviously TCFD will become a requirement for all the London funds in time. I mean, are you expecting to be able to coordinate the provision of data or reporting to meet TCFD requirements?
Yes, so the slides that I just covered that showed our kind of consolidated pool footprint are from a recent climate risk analysis that we have created in line with TCFD for the London CIV. But what we're very keen to do is to be able to provide that data and analytics for clients as well. So what we've done first is we've done a TCFD style climate metrics report on all of our listed equities and fixed income, and actually sovereign debt as well. But we will be bringing that out for a service provision for clients as well. First on listed equities and fixed income, and then gradually on infrastructure as well. So this is a service offering that we hope we'll be able to provide from June this year. We're just going to present our initial footprint, so that clients understand what metrics they might be interested in. And then of course, this is something that we can offer out to all clients within the pool on their off-pool funds as well. Not just, of course, what's invested through London CIV.
Okay, thank you.
Thanks very much, Paul and Jacqueline. Any more? I can't see anyone ask any more questions, because I think it was very well presented, and there's lots and lots of information there. I mean, probably you might wake up in the middle of the night thinking, why didn't I ask this question? But I thank you very much, both Harry and Jacqueline, for coming along to us today, and hope to see you again soon.
Yes, thank you. And sorry for the bombardment of information, but hopefully it's a bit of helpful background as to remembering what responsible investment means in a real world setting.
Yeah, certainly within Greenwich we have a policy on that, so we are very adhere to making sure that we invest our money wisely, shall we say. So we are very keen, and we do have a cross-party motion that we passed a year back or so. I forget what exactly it was, but certainly on both sides of our council, we're on the journey, so to speak, which is obviously why we've invested in this. Julian, did you want to say something?
Yeah, sorry, Chair. Just more of a comment than a question, really. Just to let the panel know that two of the funds that I think is mentioned by Jacqueline in terms of the renewable funds and looking at the low carbon funds will be presented to the panel at some point in the future. We look to bring those offerings to the panel as possible new investments. Okay, so that sort of, thank you for that. So that sort of brings us to an end of this morning's meeting. Again, just so that London should know what I'm about to say, Paul is going to be retiring. So I've already thanked him on behalf of Greenwich, and this is our last meeting. We may see each other again, who knows? But again, thank you very much, Paul. Thank you, Kenny, and officers and members for today's meeting. So see you soon.
Thanks, Chair.